Rhetoric over Trump's tariffs heating up over the weekend, with Canada's Prime Minister Justin Trudeau calling the president's move an insult. White House economic advisor Larry Kudlow saying we must put America first.
Mr. Trudeau, I think he's overreacting. I don't want to get in the middle of that. As a fine friend and ally of the United States, nobody denies that. But the point is, we have to protect ourselves.
Okay.
We must protect ourselves.
You said we need to.
Larry Kudlow also said this is like a family squabble, a feud. Joining me now with more about this tiff over tariffs, Brandywine Global Portfolio Manager Jack McIntyre. Jack, to be clear, Friday today, there is no worry showing up in the stock market here at home.
Yeah, that's correct. Well, because we know the U.S. economy is doing well. It was a strong employment report. Right, the risk, obviously, is from a trade standpoint, is it going to escalate? I think the markets are kind of keying off of Kudlow and Mnuchin versus Navarro and Lighthouser. And if that's, as long as that's the case, I think the equity market will do okay.
Jack, you know, one of the interesting things, it's Kevin Kelly here, one of the interesting things that's been a theme this year for the markets is the rising rate environment. We've touched 3.15 on the 10-year Treasury on an intraday basis. What are your worries for the fixed income markets, and are they going to be exacerbated given the trade talks, given kind of what's happening right now with our ballooning deficit, with as well as a bunch of other structural things that are going to be happening over the next decade, where we have to issue tons of debt?
Yeah, no, it's a great point. You know, the back end of that, about the budget deficit increasing, trade deficit deteriorating, I mean, ultimately, that should be weaker or drive the U.S. dollar lower, which to me is part of the solution. It would help maybe alleviate some of the trade tension in there. But so I think, I'm not that worried from a fixed income investor standpoint. I don't see a lot of inflation pressures building right now. The Fed is going to go slow. I think they've kind of given us the roadmap. So, yeah, yields are going to drift higher, but not to the point where it's going to derail the U.S. economy.
Jack, there's a front page story in the Wall Street Journal today talking about the global economic, the growth story globally is fading. Dimming markets optimism is the headline. The global manufacturing, the index there, 9-month low. Baltic Dry Index, a measure of shipping costs, down 22% since the peak last month. Copper prices also down. Can the U.S. keep growing at a clip that the Atlanta Fed thinks this quarter is going to be 4.8% growth, which is extraordinary? Can we keep growing at that kind of pace if the rest of the world is slowing?
So, yeah, I'm not sure we're going to actually print 4% in the U.S. But so I think if you look at China and the U.S. and combine those are two big, obviously, economies where data is still coming in better than expected. That's why I take the other side of that article, because I think the global economy is still on solid footing. Q1 was certainly a little bit slower. I suspect we'll see a little uptick in growth. I don't see a global inventory overhang. The key is on the corporate sector, CapEx. I suspect we'll see a CapEx cycle. Tying in the trade tensions, though, that creates uncertainty in the business community. And if it accelerates, then the corporate sector might not build out CapEx quite to the degree that they would absent those trade tensions. But bottom line, I think the global economy is still on very solid footing.
Well, on that note, there's a survey from the National Association of Business Economics. It shows many are worried about a recession by 2020. Your take on that report? Because again, we're not more than 9 years into this expansion. That would be 12. A recession by 2020 would be an expansion of 12 years. But what's your take? Because again, to introduce the worry of tariffs and what that will do to business, prices and business activity here in the U.S.
Right. So I don't think expansions have to die of old age. And the one characteristic of this expansion, as you point out, it's been long, but it's been a pretty slow expansion. So it's not strong, but it's long. But you're right. There's risk on the trade standpoint. Clearly, if this escalates into a trade war, that's going to bring forward the next recession. But if I'm right about CapEx kind of coming to the forefront, and inflation not getting out of hand, because the Fed obviously ends up ending a lot of these expansions. And if inflation remains tame, the Fed won't do it this time around. So it's a possibility. It's 18 months away, but I don't think it has to happen.
Thank you, Jack. Good to see you, Jack McIntyre.